It's time for the Your Personal Bank Show with Ferenc. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Email Ferenc, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. Yes, you will reach me. Last week, I got one of the strongest responses I have had in years, making the statement that the best, strongest index annuity product I've seen in my 27-year career has just come out, obviously was the cause of that. I really appreciate the people that reached out to me. It was quite exciting to share with them the best product, like I said, I have seen in my career. It's not exaggeration, it's just the facts. This is a product that has averaged annual returns of 10 to 14% for the past 10, even 20 years. There's no downside market risk. There are no fee options available, no caps, unlimited upside, participation rates excess of 100%. I'll explain that further in this show. If you want more information, again, it's the best index annuity product I've seen in my 27-year career, and that's not exaggerating. I'm going to share some of the reasons behind why the index annuity products have been getting stronger and stronger. And the common myth, if you want guarantees, you have to give up strong returns, is completely false, is becoming more and more so, and will likely continue to become stronger over the next 5 to 10 years, if not longer, due to long-term bond yields. This is really, really important. I have not heard this shared by many people. I think a lot of the reason behind it is most really do not understand the bond market. Most people have far more experience with the stock market. They're less familiar with the bond market. Therefore, most pay less attention to it, yet you really should for several reasons. One, the bond market is much, much larger than the stock market. When I share that fact, many people are very surprised, but it's true. Large institutional investors tend to invest in the bond market. Another reason why most people are not that familiar is the bond market is typically the realm of large institutional investors. Companies with billions of dollars to trade, sovereign wealth funds, pension funds, insurance companies, those types of entities. To participate in a bond auction, you typically need to be an institutional investor. Smallest positions are typically $100,000 or more per position. So that immediately knocks out most people, so they just don't have the ability to invest in that market. Let me tell you why you should be concerned about the bond markets right now, and why index products will most likely thrive where many stocks, real estate, and other assets will suffer. We are entering one of the most dangerous bond markets in history. First of all, real quickly, what is a bond? A bond is a debt instrument that's sold typically by a country or a company. It's a way for those entities to raise funds. Bonds are sold on certain time frames and pay a guaranteed interest rate for that time frame, much like a CD. Typically, a longer-term bond will pay a higher interest rate because the investor, the buyer, is committing to a longer time frame. Again, similar to CDs. The other difference with bonds versus CDs are bonds can be traded. And quite simply, a bond that pays a lower interest rate is worth less than a bond that pays a higher interest rate. Why there's so much concern about the bond market, and particularly the long-term rates. The United Kingdom's 30-year bond has hit the highest level since 1998. Japan's 30-year bond has hit the highest level ever recorded in history. The U.S. 30-year bond has hit the highest level since 2007. These are massive numbers. And one of the primary impacts that these high long-term bond yields is interest rates will be pushed up. You may have heard the Federal Reserve discussing higher for longer, interest rates higher for longer. The reason is quite simple. When you borrow money, the money has to come from somewhere, right? Typically, that will come from an institutional investor, like a bank or a lender, pension funds, insurance companies, etc. If an institutional investor can buy a 30-year bond and get over 5% on it, why would they be willing to loan that money to you on a mortgage for less than that? And the answer is they won't. That's why longer-term bond yields drive interest rates. It's in competition. Your willingness to pay interest by borrowing money, you're in competition with the government or companies selling bonds that are paying an interest rate to the investor. This is also why 30-year fixed mortgages are tied to the 10-year Treasury. Typically, the 10-year Treasury plus 2 to 3% gives you the 30-year fixed mortgage rate. 10-year Treasuries are now at about 4.5%. This means 30-year mortgages will soon be upwards of 7% again. These higher interest rates are also generally bad for companies because their cost of borrowing to expand and do business increases. This cuts into profitability. So generally speaking, higher long-term bond yields, higher long-term interest rates are bad for the stock market. Also, many people know higher interest rates tends to be negative for real estate. Higher interest rates can improve or enhance precious metals, but gold in particular, world reserve currency status, and general fear in the economy also impact precious metal prices. And right now, precious metals have been on the decline since the beginning of the year after an incredible run-up last year, mostly due to fears of world reserve currency status, which has now dissipated largely due to the petrodollar in the U.S. gaining control of the majority, over 50% of the world's oil reserves between the U.S. and Venezuela. So you have conflicting impacts on precious metals right now, and the fear levels of the U.S. dollar maintaining dominance as a world reserve currency have dissipated largely. Strength of the U.S. dollar as a world reserve currency is largely tied to the petrodollar. Countries and companies that want to buy oil have to do so in U.S. dollars on the world market. And when you control over half the world oil market, you basically control the market. Now, the things that will thrive in a higher for longer interest rate environment, a higher long-term bond yield, bank accounts, savings accounts, CDs, dividend-paying insurance policies, index products like index annuities, and IULs, index universal life policies. Variable annuities, interestingly, will tend to suffer because they're more tied to the markets, which tend to suffer in higher interest rate environment. I'm going to discuss, as I stated earlier, the best index annuity product I've seen in my career, why it's so strong, why it's likely to continue to produce extremely historic levels of returns. We've seen the past 10 to 20 years, literally 10 to 14% average annual returns. We've seen returns of over 20% in 1 year on these index annuity products, for example. Also, very importantly, is these index annuity products and IULs protect against downside market risk. They protect the principal. They guarantee the principal. And when you do lock in a gain, that becomes your new principal. There's also an option that you can lock in gains at any time. Therefore, if you see a strong run-up, you can lock that in and never see your account value go down in a poor-performing market. One of the most common misconceptions about annuities, index annuities in particular, have been their reputation of poor performance. Now, the reason is partly deserved because many index annuity products have performed very poorly because of the indexes they're in. If you had an ETF or a mutual fund and it didn't perform very well, you got low returns, would you blame the mutual fund or ETF industry? No, of course not. You're in a poor performing product. The S&P 500 beats 80% of mutual funds year in and year out. This has been proven and documented for decades. Indexes in index annuity or IUL products, about 80% are poor performers. And I would define a poor performer as something earning, let's say, averaging less than 7% per year over a decade or longer. Certainly some years in there, you'll see strong double digit. We've had clients receive upper 20% returns, high 20% returns in 1 year with no downside risk in poor years, with an average of 10 to 14% on average per year over 10, 15, 20 years even. These products are going to get even stronger and even better because of this bond situation we're in that's worldwide. I'm going to discuss this further and also help you understand why are the long-term bond yields, why are the long-term interest rates on bonds historically high and likely to continue, if not only to stay that way, but to likely continue to increase. And the increase, the long-term bond yields, will most likely increase the returns of many of these index products. It's been the best time in over 40 years, and it's only getting better. Stay tuned next segment, and you'll see what I'm talking about. This is Ferenc, host of Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Email Ferenc, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. I had somebody reach out to me last week and they suggested I use a different name or not do the Ferenc with no E on the end. And I appreciate the sentiment, but I thought about it for a while, and it's true. My name is unusual. It's actually Hungarian. I've shared this several times in the past. My dad escaped from the Soviets in 1956, risked his life doing so. He was a political refugee, ended up in the United States eventually, became a U.S. citizen, married my mom. I'm half Hungarian, oldest son, got dad's name. It's quite a story. It's quite a heritage, and it's something I'm proud of. My dad was a very proud U.S. citizen the rest of his life, appreciated the opportunity that this country gave him. He was the type of immigrant we want. He became an acoustical engineer, very successful in his field, raised a family, the whole deal. And it's true, when I was younger, as a kid, I hated the name because my name Ferenc, because it was so different. But as I became an adult, I learned to love the name Ferenc because it was so different. People remember it. They've probably never met or heard of Ferenc. And even when I met my wife initially online and the first time we spoke, she said, "Oh my gosh, I thought you would have an accent with your name." I'm like, "No, I was born in Kansas City, Missouri." So I'm as American as it comes, but I am half Hungarian. My dad's heritage, something I'm proud of. I've come to love it. Although I appreciate the sentiment and I appreciate the thought that this listener reached out to me, it's something I don't want to let go or give up. And I understand some people may have a hard time or they may misspell the email. But again, you can go to my website, yourpersonalbank.com. You can go to the app, the Your Personal Bank app. You can call me, 866-268-4422. Or if you want to, email me, Ferenc, Ferenc, at yourpersonalbank.com. And yeah, maybe I might miss a few folks that reach out to me, but I think the risk is worth it. It's important to me, but I appreciate the sentiment. Now back to this issue we have with the bond market right now. This is a really, really big deal. The bond market crisis is intensifying. We are seeing record high yields, interest being paid on long-term bonds worldwide. This type of high bond yields, generally for the economy, is not typically a good thing. Interest rates will be pushed higher. They'll stay higher for longer. Typically it's a negative on the stock market in general because higher costs of borrowing reduces companies' profits. Real estate suffers with higher interest rates. Many assets do. Now, there's some that shine. There's always winners and losers. That's one of the things I always point out to people. Winners are bank accounts, savings accounts, CDs, dividend-paying insurance policies, index universal life, and index annuities. Insurance companies primarily invest in these types of assets, and when they get a higher interest rate, it's more profitable, which they're able to pass on to the investor, to the policy owner. Therefore, higher dividends, higher interest. We're already seeing some of the best rates we've seen in 40 plus years. I've shared in the last week or two, the best index annuity product has come out that I've seen in my 27-year career. And the future for that industry, for those types of products, has never been brighter, at least not in my lifetime. This is likely going to lead to an economic sea change, or a revolution even, if you will. The things that worked in the past, did well in the past, think back most of the past decade, stocks, real estates, things like that thrived in that economy are likely going to suffer in the future, and vice versa. Super low interest rate environment was great for stocks, real estate, cryptocurrency, etc. It wasn't that long ago if you went into a bank and tried to get you couldn't get a 1% return on a CD, regardless of how long you wanted to invest. Today, there's 4% CDs. That's over quadruple increase, and those are likely going to continue to increase. We have dividend-paying insurance policies that are paying 6.5% now and are on the rise. All predictions show next 5-10 years will continue that way. IULs, index annuities, are already paying some of the highest returns we've seen in 40 plus years. It is the golden era of fixed assets and are on the rise. That is likely to continue for the foreseeable future. Why? Again, it has to do with the long-term bond yields, the interest rates hitting the highest levels we've seen in Japan, for example, ever recorded. United Kingdom, highest we've seen since 1998. In the United States, the highest since 2007. These are significant numbers. If you're borrowing, interest rates are likely going up. If you have a variable interest rate, things aren't going to be pretty, most likely. Why are these bond yields, interest rates so high and climbing? The primary driver behind all this is the Western world has taken on record levels of debt. The United States alone, for example, is approaching $40 trillion in debt. And when a government like the United States prints currency and they spend more than they receive, which we continue to do at about a $2 trillion clip per year, they can't just print the money willy-nilly. They have to sell a bond. Somebody's got to buy that bond. Who buys those primarily are institutional investors, sovereign wealth funds, central banks, pension funds, insurance companies. And Basic Economics 101 tells you that when you have a record amount of supply, what happens? How do you entice? You have a record amount of bonds that you're selling that's on the world's markets. How do the bond sellers, these countries, companies, etc., get the buyers to buy these bonds? Well, they have to raise the interest rates. They have to sweeten the pot. And as more and more of this debt continues to be sold, it continues to push the prices up. We're at the very beginnings of this cycle. That's the scary part and what many of these warnings are sharing. Most predictions are higher for longer. The Federal Reserve has stated that now for a couple of years. Most economists and experts, projections for the next 5 to 10 years, at least, if not longer. Why? These governments are not getting their fiscal house in order. They're not getting serious. They're still spending more than they receive, which keeps feeding the fire. Now, I know there's a lot of fear and concern about losing world reserve currency status for the U.S. dollar. I have very little fear of that right now because of the petrodollar. The U.S. does control over half of the world's oil supply between the U.S. and Venezuela. We dominate the world's oil markets now. Therefore, the U.S. dollar's world reserve currency status is quite secure. In fact, recently, China has now started buying oil from the United States even. It's a shocking development. So the world reserve currency status of the U.S. dollar is pretty secure. And that's largely why you're seeing precious metals, gold in particular, dropping in values since the beginning of the year. There was a lot of fear of that last year and why it ran up so much, and that fear is now largely dissipated. But as I've said, fixed assets, bank monies, insurance-type monies, assets that their returns, higher interest rates thrive. Those are the things that are going to thrive. And how will you know when this cycle, which I believe we're at the beginning of, as most experts do, how do you know when this cycle is going to start coming to an end? Well, the answer is quite simple. When you start seeing governments like our federal government start getting their fiscal house in order, stop spending more than they're receiving, and start balancing their budgets. Right now, does anyone see any sign of that at all? Is Congress cutting back spending at all? The answer is no. So we're nowhere near the end of this cycle. We are at the beginning of this cycle. Now, eventually, those things will happen. Another reason why the world's bonds, long-term bond yields, are increasing is largely because inflation has been coming back. And part of the reason why inflation has been coming back as much as it has to do with the global money supply. In just the last year, the world's money supply has increased over 9%, and much of that comes from China, not the United States. China has increased their money supply by over 13% in the last 12 months. China is now the largest driver of global inflation. So unfortunately, despite the fact that we are not printing money as much as we were before, and with our new Fed chair, likely that will decrease further, will help improve our financial situation, China is pushing the opposite. And that has an effect on the world economy. It also weakens the Chinese yen, which is another factor that will strengthen the dollar. This is why 62% of global fund managers now expect the 30-year bond to hit 6%. Barclays and Citigroup are warning the 30-year Treasury could hit 5.5%. And history doesn't repeat itself, but it often rhymes. And you need to be aware of this. When the 30-year Treasury hit 5% in 2007, most people ignored that too. 12 months later, they found out what that meant. History is rhyming. The central banks of the world are losing control of global inflation. It's now rising in 27 of the 29 major countries in the world at the same time. This is driving the bond yields up. This is not something the Federal Reserve can stop. In fact, I'm going to encourage you to stay tuned in the next segment because I'm going to share with you what's the most likely scenario of what the central banks, including the Federal Reserve, are likely to do next. I'm Ferenc Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com. This is Ferenc, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. Yourpersonalbank.com. Email Ferenc, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. Yes, you will reach me. I never fail to be abused when I have somebody reach out to me and they're so surprised that I actually get back with them or sometimes even answer the phone. I had this happen a couple of days ago. If you call, I'm not going to guarantee I'll answer every time. I might be meeting with a client or doing something else, obviously. But if I'm available during normal work hours, I will answer the phone if it rings. And I did this a couple of days ago. This listener, he goes, "Oh my gosh, I can't believe it. You expect you to answer the phone." I'm like, guess I'm a little old fashioned. I like connecting with people directly. And I do my best to answer the phone when I can and obviously get back with you when I'm unable to. I've even had marketers, like for my website, the app, various things, try to convince me to set up a service or these types of things. But once I point out to them that that's one of the key differentiators, I like the personal touch. I'm a little old-fashioned. I think most people like that too. And if you actually get to talk to a live person and not some machine where you have to push 10 different selections to get to a person or just to even leave a message, that's pretty annoying. Like I said earlier, I'm not able to answer the phone every time. I do my best. But if you leave a message, I'm usually able to get back with you within a day or so, depending on how busy I am at that time, how many folks are reaching out to me. And it's a passion of mine. I enjoy talking and meeting with folks, answering questions, sharing ideas, enhancing their financial situation, and oftentimes sharing something with them that maybe they haven't ever heard before. Perfect example was a gentleman I met with this last week who had done a lot of due diligence on index annuity products. He reached out to me because a few things that I mentioned struck home when I stated just because you've had poor returns on your index product doesn't mean the industry is bad or it's the product's fault. It's just you're in a poor index, most likely. And I mentioned that there are many products available with no cap, no fees, no caps, unlimited upside. Well, that kind of shocked him because, as he stated, he had met with 2 or 3 different financial people, had discussed index annuities, and had been told by more than one that there was no index annuity product, for example, that existed without a cap. And then when I did the search with him, when we found upwards of 300 products available for him based on his age and the state he was located in, one, he was shocked to see there were so many options. There were dozens of companies. Share with us, I say, look, if you talk to somebody about an index product or any financial product for that matter, and they're not able to show you dozens of companies and hundreds of product options, that pretty much probably tells you they're not independent. The industry states about 90% of agents and advisors are not independent. They work with some organization. Therefore, their product offerings are somewhat limited. They may or may not have the best product available. And then I showed him dozens and dozens of index. There's hundreds of indexes, by the way, folks. And I was able to show him several dozen examples just in a couple of minutes, all having no caps. Well, that just kind of floored him. I kind of shocked him, one, by answering the phone, and then we set up a Zoom meeting call and then showing him all the different options available with no fees, no caps, unlimited upside. I had another gentleman I just met with today. In fact, we were comparing an existing index product he had. His return last year after fees, net, was 1.25%. Now, obviously, that's horrible. The primary reason why his return was so low, it turns out in his case, he had a great index. He was in an S&P 500 index that returned strong double-digit returns last year, yet he had a cap on that, an annual cap, plus fees on top of that. He had rider fees and such, which meant his net return, when it was all said and done, was literally 1.25%. Now, that's even lower than the average that I run into, but it was pathetic. I was able to show him that product I was recommending for him, that if he had invested in that product instead, his return would have been over 20% last year, net, into his account. The difference was almost 20-fold difference just in 1 year. In his case, he even had a penalty to get out of the old product. The new one paid a bonus, which put him ahead day one. So he had more money in his account day one after the early surrender penalty with the bonus. And if next year turns out to be similar as last year, his returns could easily be over 10-fold more. I mean, that's what happened last year. This is the type of thing I run into all the time because, again, index annuity products have increased fixed assets, particularly index annuity products, and improved so significantly because of this long-term bond yield curve. We're seeing historical highs. The reason behind it is real simple. When you give an insurance company money, what do they do with it? They invest it. And primarily, they invest it in bonds. Now, what they do typically is they buy the bond and they put it in their safe and they never touch it. That ensures and guarantees the principal. The amount of the money you gave them is there. Now, what do bonds do? They pay interest. Insurance companies then buy options with the interest off the bond. Again, they never touch the bond itself, the principal. They're only risking the interest off the bond. Now, if you understand options can increase dramatically. You can get a well over 100% increase in an option in a year, in a good year. And even on a small amount of money, that could translate to a solid double-digit return on the overall account. Now, they run the numbers and calculate this as they're very intelligent on how they run this. So if your index, for example, went up 10%, or 20% or whatever that was, they calculate the option return so that you get credited that 10% or 20% or whatever that return was that year. By the way, how do insurance companies make money on these? Quite simple. The ones with no fees, which many of these products have, no fee, no cap, unlimited upside, 100% or more participation rate in the index, which means you get 100% of whatever the index does or more. They even enhance it, bonus it, if you will. How do they make money on those types of index strategies? Again, quite simple. Those options often in a good year can return 100, 200, 300% even or more. You're getting credited the gain, whatever the index was, as if you had invested in that index directly. So if it was a 10% return, you would get 10% credited into your account. The overage, the extra, the insurance company keeps. That's their profit, the cost of doing business, and how they pay me, by the way. That way I don't have to charge you fees. I get paid commissions by the companies, which is how most financial people, regardless of what they call themselves or their title, I know they get mad when I share this, but it's true. If a financial person recommends a product to you, you purchase it, they typically get paid by that company, and in most cases, it's in the form of a commission. I get paid the same way. Many financial people also charge fees, money under management, other types of fees. I chose not to, 7 years ago now. Done real well, been successful. If you're not getting charged 1% a year, for example, in fees, that means in a decade you got 10% more money, don't you? Without compounding. So that's how the index strategy, how the index products work, the index annuities, IULs. When we're talking about an index strategy with no fees, no cap, unlimited upside, and participation rates upwards of 100% or greater. And there's many of those available. Now, there are other index options that do have fees. Typically, 1% is sort of the high end, the max. And sometimes there's a reason to do a product with a fee because it might be in a better index, higher potential upside. We have a number of products with 1% fee, no cap, unlimited upside, and tremendous participation rates, 180% or more even participation rate. What does that mean? It means if that index went up 10% in a year, you would get credited 18% minus the 1% fee. So your credit into your account would be 17% that year. I had a bunch of clients get that last year, for example, in the last few years, really. Obviously, with a fee structure, one with a fee like that, where they're charging the 1% fee, that's how the company's making money there. I'm generally not a fan of cap products. And the reason behind that is quite simple. A cap is what it exactly sounds like. A cap limits or caps your upside. So unless it's a really high cap, generally I don't recommend it. I find that, again, those limit your upside. And the problem I run into, the negative perception that many index annuities, IULs, have obtained over the years is because people are in indexes, either in a poor performing index or they're in a good index, but one with a cap, like this gentleman I shared with earlier, where he had a 4.25% annual cap on an S&P 500 index. I'm sorry, that's pathetic. That's terrible. That means the maximum returns in a year are 4.25%. And that's an index that can easily, past year, did well over 20% returns. So you're giving up the difference. That's horrible. Why not get into an index, an S&P type index where you have no fee, no cap, unlimited upside, and you're receiving close to 100% or even more of the returns? This is real, folks. This isn't exaggeration. This is what I'm dealing with on a weekly basis. This is statements that I'm looking, annual statements from clients, actual returns, net into their account, because that's what counts. That's what matters, right? What has been credited into your account. And because the long-term bond yields, the interest that these long-term bonds are paying, which is the primary investment tool of most insurance companies, because they're paying more interest, that means they're able to buy more options. The ability to buy more options then increases the returns that the insurance company can pay to the investor. And if long-term bond yields continue to stay strong, which almost everyone believes will be the case, or even will get stronger, that means the returns will increase even further. It was interesting. I had two separate listeners reach out to me this last week who had been bankers their entire career. Very sophisticated, understood financial tools and products. Both had invested in many, many different financial tools throughout their lifetime, both personally through their banks. One, for example, stated, "I've invested in nearly everything, yet have avoided annuities because of their reputation of poor performance." When I shared, don't judge the entire industry due to a poor performing product and that there's no cap, no fee products available, unlimited upside, that got his attention. When I shared this information, met with these two separate gentlemen, two parts of the country, both career bankers. One of them even mentioned, he goes, "Wow, why would I consider putting my money at risk to the market?" I shared, that's the conclusion many people come to once they really understand how these operate. When you're looking at a product that has averaged 10 to 14% average annual return for 10, 15, 20 years, actual returns, net in your account, there's no downside risk because the principal is guaranteed. So in a poor performing year or a negative year, you don't lose. It's tax deferred. So if you leave the money in there and let it grow, you don't pay taxes year to year. It starts to become very appealing for a lot of folks. And why it's become so popular and why even many Wall Street firms years ago would disparage index annuity products and now offer them themselves. I guess it comes down to when you can't beat them, join them, right? Stay tuned in the last segment. I got a few more thoughts about the economy and things that are going on with the markets, with the U.S. consumer that I think you should be aware of, and why protecting the downside through an index product could be a very, very good solution for you. So stay tuned. This is Ferenc, host of Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed.
3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Email Ferenc, F-E-R-E-N-C, no E on the end, F-E-R-E-N-C at yourpersonalbank.com or 866-268-4422. And yes, you will reach me, much to the surprise of a couple of listeners this past week. I actually even answered the phone when they called. They were shocked, but it's kind of, I have fun with it. I think it's fun. Hey, this is Ferenc. Like, are you the guy on the radio? I said, yeah, that's me. And they're like, wow, I can't believe, you said that on the radio. I'd be able to reach you. I didn't expect you to answer your phone. As I said it earlier, I don't always able to because I'm in a meeting, or if I'm able to, I will, or I'll get back with you. So here's some things we need to be aware of what's going on. The bond markets across the world, the Western world, are climbing. We're seeing historical yields, interest rates on long-term bonds like the 20 and 30-year bonds. Highest levels ever recorded in Japan. Highest levels in the UK since 1998. Highest levels in the US since 2007. So this is a really big deal. And typically speaking, when the bond yields increase like this across the world, that's one of the best predictors of a recession. I'm not rooting for a recession, but we have to face reality. Here's another very strong indicator. Walmart stock dropped recently after the CFO posted a worse than expected outlook. And his statement was simple: consumers are running out of gas. He went on and stated that higher tax refund masked the higher cost of things in Q1 of 2026. But most of that tax refund money has now run out. The bigger picture is Walmart for the last couple of years has been targeting higher income shoppers, specifically because they saw the lower income consumers tapping out. They just couldn't afford the prices of everything. The cumulative increases of inflation over the past 5 years has tapped out many of the lower income consumers. The problem Walmart pointed out, though, was now even the households with over 100K of income, which has been a large part of their growth over the last couple of years, they're starting to pull back. They're starting to be impacted by the higher consumer prices also. This does not bode well. Walmart is probably one of the cleanest signals you're going to get of where the consumer is really at. Also, over 13% of credit card balances in the U.S. are now over 90 days delinquent. Over 10% of student loan balances are 90 days delinquent. And over 5% of auto loans are also over 90 days delinquent. All of these are some of the highest levels ever recorded. This is why hedge fund short positions have nearly doubled since 2024 and have rarely ever been this high. Short positions are even higher today with hedge funds than they were in the meme stock frenzy that occurred back in 2021. Hedge funds are extremely bearish right now, historically so. Another warning sign and concern for if a pullback starts to occur and it could accelerate dramatically is U.S. margin debt has spiked to $1.3 trillion, which is an all-time high. This is leveraged borrowing of stocks. And margin debt now reflects over 5% of U.S. GDP. That is a massive, massive number. There's never been this much leverage in the stock market. That is concerning because if a correction starts to occur and the investor, the fund, is leveraged, because they're leveraged, gains and losses are both exaggerated or multiplied. So if a correction occurs, they have to get out or their losses will mount quickly, which can force something called margin calls, which requires you to close your positions and pay the brokerage firm in 24 hours the difference, the losses. And those can mount quickly and dramatically. This is why the old statement is the markets go up like an elevator but drop like an escalator. It's because of margin debt oftentimes, and we've never seen it higher. And that's why I can't stress enough. Although, yes, with these index annuity and IUL products in the last 3 years, we're seeing the best returns we've seen since the 1970s. It's the golden era of fixed assets. It truly is. Long-term bond yields are allowing these companies to buy more. The long-term bond yields, the interest, the profits these insurance companies are earning are allowing to enhance returns more and more. They're becoming extremely competitive against even direct stock investments. But the big thing is they guarantee the principal. We've had a tremendous run-up in the stock market recently. Typically, those types of run-ups are unsustainable. Corrections occur. Corrections are natural. I get that. But when you add a correction onto historic margin debt, that can exaggerate it further, quickly, dramatically. When you add on top of the likelihood of recession has increased dramatically due to the long-term bond yields worldwide, the consumer is pretty tapped out, according to Walmart. They would know, probably more than almost anyone. Debt is at record levels, whether it's credit card debt or whatever. I'm generally not a doomer and gloomer, if you know what I'm trying to say. But the risk in the short term has elevated and elevated significantly. And the bond market is in fact, the bond market is screaming that fact. And until recently, the stock market is ignored. One of them is wrong. Either the stock market right now is wrong or the bond markets are wrong. And the bond markets are far, far larger than the stock market. Large institutional investors, sovereign wealth funds, insurance companies, pension funds invest in the bond markets primarily. It's usually not wise to vet against the big money. They're not always right, I understand, but the majority of the time they are. And I just want you to understand here, I'm not saying the sky is falling, but what I am saying is the risk is definitely elevated. If you have assets at risk, pulling back on that risk would be extremely wise. Diversification is always wise to minimize risk or mitigate risk. But now the risk has gotten elevated again significantly. And we have products that can allow you to continue to earn tremendous upsides. I've had a number of people make 27% last year in their index product, but many of them in the 20% plus range last year. Long-term averages of 10, 11, and now even 14%. Average returns over 10, 15, and 20 years, but no downside risk. The principal is guaranteed, and the gains once locked in are also guaranteed. And there's even an option to lock in the gains at any time you want. You don't have to wait a year. You could do it any time throughout. And I'm going to share one last cycle here that I thought was extraordinarily interesting. If you go back to 1920 and you look at a history of innovation and how the stock market in general responded to the innovation booms and then bust cycles, what you find is about a 24 to 25 year period of innovation. For example, in 1942, modern electronics and early computers drove a 24-year boom. And then there was a 9-year flat down period. And then in 1975 was a 25-year PC boom and internet boom. And then we had a 9-year down period. In 2009, smartphones and then AI, largely technology, drove a 24-year boom. We are at the 24-year period. If this technological cycle repeats itself, then the next 9 to 10 years will be flat or down. Now, it's impossible to predict that. And history doesn't repeat itself, but it often rhymes. This cycle has repeated itself 3 times in the past century. Will it do it again? And if it does, what did you do to protect yourself against it? Did you reallocate some funds? reduce the risk, maybe put them into an index annuity or IUL product so you could continue to gain upside returns when the indexes went up, yet not participate in the downside when they dropped. And then when the recovery does occur again, because it will, you could restart with the greater amount of money from the higher point. So you don't have to suffer the loss and then the time it takes to recover from that loss. If the index or markets go down 20, 30, 40%, whatever, how long does it take to get back to even? And did you make any money during that time when it's coming back to even? The answer is no. You're just retracing old ground. Would it make more sense to not take the hit, keep the funds, and then when the recovery occurs, take advantage of that recovery and move from the higher point? This is why practical personal experience for the past 27 years, when I see folks with good index products, good IULs, good index annuities, strong indexes, typically low or no fees, typically no caps, unlimited upside, strong participation rates, in 5 or 10 year period, oftentimes they have more money than they did investing directly in the markets because they did not participate in the corrections. And if you say that's old news, 2022 alone, the S&P 500 dropped 20% roughly in that calendar year. If you don't believe me, look it up. It came back from that. Of course it did. But if you didn't have to make up the 20% and you went up from the higher number, would you have more money? In many cases you do. That's the difference of an index product with guarantees and strong returns versus direct investment. Am I saying you should put all your money in there? For some people, maybe. Others, it's a great diversification strategy. If half your money was protected against the downside and we had a correction, wouldn't it be nice to know that at least half your money was protected and you knew that it was there, and when the markets recovered, you could go up from there? The increased bond yields, the high interest on the long-term bonds is happening worldwide. It's quickly becoming a crisis. Federal Reserve doesn't have much control, or central banks, of long-term yields. They have impact on the short-term yields. Not only do the central banks will likely not cut rates because inflation has been increasing, China's been printing money like crazy, there's more money in the world market than ever. Many are saying that the central banks are likely will raise rates next, which likely will have a pretty devastating impact on the markets, the stock market in particular. Protect yourself. This is the best time. This is the golden era of fixed assets, the best time in over 40 years for index annuities, IULs. The best product I've seen in my 27-year career literally has been released by one of the largest companies, A+ rated, one of the big boys. There's never been a better time. Contact me at yourpersonalbank.com for more information. Stay tuned to the Your Personal Bank show for some more great info. And as long as it's on our money, in God we trust.
Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information.
I'm Ferenc Toth, host of the Your Personal Bank show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.